We've covered three valuation methods: the constant growth method, the variable growth method, and the free cash flow method. There's also some other valuation methods, including the book value per share, which would be the value of the firm if all the firm's assets were sold at their exact accounting value. This method obviously can be criticized because it relies on historical data, and that historical balance sheet data probably has no relation to the firm's value in the marketplace. So to calculate the book value per share, an example, the balance sheet shows total assets of $6 million, total liabilities including preferred stock of $4.5 million, and 100,000 shares of common stock outstanding. Its book value per share therefore would simply be the $6 million total assets minus the $4.5 million in liabilities, not counting equity, divided by 100,000 shares. That would give us a book value of equity per share of $15. We could also look at the liquidation value per share, and this is the actual amount per share of common stock that would be received if all the firm's assets were sold at their market values. Any liabilities, including preferred stocks, were paid, and any remaining money were divided among the common stockholders. While this measure is more realistic than book value, because it's based on current market values of the firm assets, it still fails to consider the earning power of the assets. By the way, a complete aside here, a little bit at least, is my next door neighbor works for a regional railroad company, and he was telling me that the liquidation value per share of his railroad was quite a bit higher than its going concern, because when you think of a railroad, they have all the right-of-ways, all that real estate that's associated with them, as well as all that scrap metal. He said if all the metal was sold for scrap and they were sold all their real estate, they would have a value that was much higher than its going concern value. However, legally, they're constrained. They cannot do that. They cannot, the railroad, because of its monopoly, it's regulated, they cannot simply sell the right-of-way, all the real estate. So they're constrained in that sense. So calculate the liquidation value per share. Again, doing this example of Lamar Company, this is in the textbook. They found they could only get $5.25 million if it sold its assets today for the liquidation value. So the liquidation value per share would be the total liquidation value of $5.25 million less those liabilities of $4.5 million divided by the 100,000 shares. That would give us a $7.50 value per share. Now, if concept check real quick, if the liquidation value of a corporation exceeds the market value of the equity, then the firm has no value as a going concern. The firm's stock will sell for book value. The firm's not taking advantage of available growth opportunities, or the dividend payout ratio has been too high. Well, setting aside my example of the regional railroad that's liquidation value was greater than its going concern value, typically if a firm's liquidation value exceeds its market value, it has no value as a going concern. Another common stock valuation technique is the PE ratio. The PE, or price earnings multiple approach, is a popular technique used to estimate the firm's share value, and it's found by multiplying the firm's expected earnings per share by the PE ratio for the industry. So for example, if the company is expected to earn $2.60 per share next year, and we have a industry PE average of 7, the firm's price per share would be 760 times 7, or $18.20 per share.